If you are paying private mortgage insurance on your conventional loan, you might be closer to removing it than you think. Here is exactly how to get rid of it. PMI is required on conventional loans when you put less than 20% down. It typically adds $50 to $150 per month per $100,000 borrowed. That adds up fast. There are two ways PMI gets removed. The first is automatic. Your lender is required by federal law to cancel PMI once your loan balance reaches 78% of the original purchase price. That means 22% equity based on the original value, not the current value. This happens automatically based on your payment schedule. The second way is faster. You can request PMI removal once your loan balance reaches 80% of the original purchase price. You send a written request to your loan servicer, and they must honor it as long as you are current on your mortgage with a good payment history. But here is the part most homeowners miss. If your home has increased in value since you purchased it, you can request a new appraisal and have PMI removed based on the current value. In Solano County, many homeowners have seen significant appreciation in the last few years, which means you might already have 20% equity even if you put 5 or 10% down. The rules for this vary by lender. Some require the loan to be at least 2 years old. Some require 5 years if you want to use the new appraised value with less equity. Check with your servicer on their specific guidelines. If you think you might have enough equity to remove PMI, I can help you run the numbers. Book a free consultation. The link is in the description.